Welcome to the Lend Academy podcast, session number 22. This is your host, Peter Renton, founder of Lend Academy. Today on the show, I'm delighted to bring on one of the true leaders of our industry. Mike Cagney is the CEO and co-founder of SoFi. And you probably know about SoFi from the student loans, and they've done close to $1 billion. But SoFi have also broken some new ground in this industry. They did the first rated securitization of our industry in December last year. And more recently, just in the last few weeks, they did an S&P rated securitization. And we talk about that and the significance of that securitization for this industry. And we also talk about some of the new areas that SoFi are looking to go into, some fascinating plans they have. And you'll find all about them in this episode. Hope you enjoy the show. Okay, welcome to the podcast, Mike.
Thanks for having me.
Okay, so why don't we just get started with telling the listeners a little bit about your background and how you came to start SoFi.
Sure. So just by means of background, I started in banking back in '94. I worked at Wells Fargo and ran structured product development, proprietary trading, and a few other things for the bank. And in early 2000, I left to do a technology startup that I grew and ultimately sold to Broadridge. I'd left the operating side of that business in 2005 and started a hedge fund called Cabazon, which runs about $1 billion for 18 family offices based out of San Francisco. And in 2008, when the world was falling apart, one of the families that I knew very well, worked very closely with, came to me and said, the financial system breaks every 25 years. You're a smart guy. Why don't you try to figure out a different kind of model? So I went out and looked at what was happening on the entrepreneurial front within financial services, and I happen to know Chris Larson pretty well over at Prosper. And I sat down with Chris to talk about what he was doing in the peer-to-peer lending space, which I thought was an absolutely fascinating space in the context of disintermediating the banks. It was early in the process, and there were some challenges that I felt the business model had, but I was pretty excited about this concept. But we ended up not doing anything with Chris at the time, and a couple more years passed, and in 2010, a good friend of mine asked me if I wanted to go down to Stanford and do a fellowship for a year at the Graduate School of Business. And I've been staring at a Bloomberg screen for a really long time at that point, and decided that it was a good opportunity to step out and think about big picture financial services and how to solve a problem. So went down to Stanford and really with the idea of creating a marketplace for an affinity-based financial solution. And serendipitously, I met a couple of my co-founders here at SoFi, Dan Macklin, Jim Finnegan, Ian Brady. And we all started talking about this marketplace concept. And what we were looking for was a vertical to best demonstrate how this could effectively work. And we looked at ideas in banking, brokerage, insurance, and ultimately decided to settle on student loans as a first product. And that might seem like a little bit of an odd asset class choice because it's, certainly in the press, not favorably, and it certainly has some challenges as an asset class. But the reality is it's a $1.3 trillion market, of which there's a lot of very good credit in there. 65% of the students at Stanford's Graduate School of Business were borrowing at the time, so we had a lot of folks who were using the product, including my co-founders. And most importantly, it really tied into this affinity marketplace concept with the idea that you get alumni investing in a fund that funds fellow alumni and students from their school, where you can create on the borrower side a moral suasion that you don't want to default because it's your community funding you, and you build transparency into that. And on the investor side, you're creating a structure where you not just have an economic incentive, but also an affinity incentive for that borrower to do well.
Right, sure. So you started on student loans, but it sounds like all the time this was only going to be a starting point. That was your plan, just to really launch the product here, launch the business here, and then move on from there. Was that always the plan?
Yeah, that's right. And effectively what student loan refinancing gives us is it's almost a Trojan horse. It allows us to build a beachhead into a very interesting customer demographic that looks very much unlike any other peer-to-peer lender. So our average borrowers are around 32 years old. They've got a 780 FICO. They make $150,000 a year pre-bonus, over $5,000 a month of free cash flow. And because of that borrower demographic, it allows us to go after different areas in the market to deliver a solution than the existing peer-to-peer folks are competing in. So we're not a big card consolidation play like a Prosper Lending Club, and we have no aspirations to go into small business lending, but we certainly do have aspirations to go into mortgage lending, and in fact are already there, auto loans and other types of credit that represent a much larger chunk of that 11.5 trillion of consumer credit outstanding.
Right. So we'll get to those other areas in a second, but just wanted to focus on that one point that you talked about, these super prime borrowers. I mean, high 700s FICO score, high income. Is this the segment of the market you are completely focused on? You're not, these are, these are even beyond what you get as an A-grade borrower at Lending Club. I mean, these would be A-grade borrowers at Lending Club or AA at Prosper. Is this market your total focus, and what is the size of that market?
Sure. So it's absolutely our total focus. And it doesn't mean that we don't do some lending outside of that core market. So, for example, Stanford asked us to create a Parent Plus loan program for them because they didn't like the government program. And we've done that, and it's been extremely successful. But the real bread and butter for us is focusing in on what the market calls a Henry, which is an acronym for high earner, not rich yet.
Right.
And it's someone in their early 30s with a lot of free cash flow and not a lot of assets. Now, if you look at the U.S., if you look at that 25 to 40 age demographic and you cut out, say, the top 5 to 10% of that, you're dealing with at least 3 million, maybe upwards of 5 million people. So you've got a relatively large market opportunity well beyond the size of the student lending market.
Right. Okay. But obviously you're only going after the super prime of that market. I mean, not every 25 to 40-year-old is going to have a 780 FICO.
Right, but the 3 to 5 million represents the super prime of that slice.
Okay, great. So, it seems like you did your first securitization in December. It was a rated securitization by DBRS. So, can you just tell us a little bit of the details about that deal, and also why did you decide to go down the securitization route?
Sure. So I'll talk about the latter point first and then get to the details. From our standpoint, we like to diversify the funding sources that we have, and we like to keep the alumni retail investor engaged irrespective of what that funding source is. So when we do bank participation, and we have a very large program there, we slice a portion of every loan back to SoFi and the alumni. When we do securitization, the way that securitization works is you take a pool of loans and you break it into two pools, a senior and a junior tranche. That junior tranche always has retail alumni participation in it. And the benefit of securitization is when the markets are open, it's generally your lowest cost of financing. And a caveat that the securitization market will shut once every 5 to 7 years. So it's not a structure that you can rely on to be there all the time. And we certainly saw this blow up in 2008 with other student lenders like My Rich Uncle that were beholden into that market, didn't have the right structures in place, and when it shut down, they imploded. But when it works, it can give you the lowest cost of capital. And for example, I know we'll talk about the one we just did in July, but the all-in cost of capital, equity and senior debt in that structure was about 3.5% to us.
Wow. Yeah, that's great. And so you have the equity piece, which is that all individual investors in that equity piece? I mean, you said you talked about the alumni investors. Is that the?
Yeah, we have a little bit of institutional in there as well, and we do that just for no other reason than to get the retail folks comfortable that it's priced correctly and appropriately, and they're pari passu to the institutional folks in these structures. But it's predominantly been retail money.
Okay, so then let's talk about your second one. You just mentioned it. You just did it in July, a bit over a month ago. You got a rating by Standard & Poor's, despite the fact that they had released a memo, I think just a few weeks before that, saying they weren't really going to participate in this asset class, the unsecured consumer loans. So,
right.
So how were you able to pull that off? And also, what is the significance of this for the whole industry?
So this is huge for the industry, because if you look at the DBRS transaction, And I promise I'd talk about some specifics of it, and I haven't, so let me do that very quickly. The way that we got DBRS comfortable without having 3 years of operating history, because that's effectively what they want, is they have the cohort default rate numbers for the schools of our borrowers. And they said, we're going to use these as a proxy for credit performance. And so rather than having to have a long track record and a tape that we could show them, we simply said, well, here are the schools that our borrowers are from, representative, and they went and looked at the cohort default numbers and pulled together a default profile for the transaction. It was, your first transaction is always your most difficult. It wasn't without hiccups as we went through the process, but it was done effectively at the end of last year. The S&P transaction is important because they did not look at the cohort default numbers. They purely looked at the way we were underwriting. And this is important for SoFi because that means we could go into any asset class, any particular loan type. So whether it's a mortgage or it's a personal loan or it's an auto loan, as long as we're underwriting consistently to the way we underwritten the student loans, we can get a rating by S&P in the market. So it's important for us because it opens up a large number of incremental loan types that we can fund into, knowing that there's liquidity for the market. But it's also important to anyone else in the space because they can basically follow our lead in how we underwrite, which is not against DTI, it's against free cash flow. And it looks like the rating agencies are very inclined to accept that as a better way of underwriting and evaluating credit. The S&P transaction, it was the lowest expected cumulative default they've ever assigned to an unsecured credit pool.
Wow.
And we have over 10,000 borrowers. We're coming close to $1 billion in lending at this point. And we funded $115 million last month and should fund about $135 million this month. And we've never had a default still. So now they will happen at some point. And some of why we don't have defaults is, as you know, we've got some very interesting borrower protections where if you lose your job, we get you reemployed. But if you go more than 90 days, we count you in the delinquency category, and that's not happened. So when our borrowers have run into trouble, we've been able to go into the community and get them reemployed pretty quickly, and that certainly helps the performance of the book.
That's right. So that is a very impressive record that I think any platform would be extraordinarily happy to have. So just on your underwriting, so if you're in a Stanford MBA program and you're taking out a loan, you're looking to take out a loan, are you only taking certain slices of those people, or the mere fact that they happen to be in a top school and a top MBA program, is that enough for them to get the loan?
Sure. So effectively, we do two types of lending. So we do a very small amount of in-school lending, and it is limited to MBA programs and a finite number of MBA programs. And as long as you have a sufficient FICO score, which really means you don't have derogs on your credit, we'll underwrite that loan. Now, we're not big FICO-based lenders, and so once you graduate, your FICO score becomes pretty much irrelevant in the underwriting process, other than it's necessary to ensure there's no derogs in your credit. What we're effectively looking at, and the two biggest factors that drive our decision in terms of where we price your loan, is your free cash flow. And free cash flow is a function of where you live. So we take your income, we take your assessed taxes, known liabilities that you have, and then also where you live. So someone in San Francisco is going to have less free cash flow, ceteris paribus, to someone in Ohio. And we underwrite against that, and then years of experience. And so those two factors really drive the underwriting process for us. We end up with very high FICOs, not because we're optimizing on FICO, but because people that have a lot of free cash flow with 5 to 6 years of work experience tend to be very high FICO credit.
Right. Okay.
So it's more of a byproduct than it is an optimization to that score.
Okay. So today, are you still attracting alumni investors? I mean, you've obviously got a track record now that's really fantastic. Are you seeing more of the alumni coming on board? Are you trying to bring in new retail investors? I mean, where are you at with the investor mix?
Yeah, we are, and we're constantly trying to make it as easy and digestible as possible for retail investors. As you could imagine, retail investors investing directly in the equity on a securitization is not the most simple and straightforward process,
right,
relative to other investment options. And so we're working on ways to streamline and make it easier. But we're effectively right now doing a couple of different products for alumni. We have a perpetual preferred stock that we're issuing that it pays out a 6.5% coupon. It's initially a return of capital, so that even though we're profitable on a GAAP basis, it's still constituted as a return of capital today, and then it becomes a qualified dividend. And it's got a convert option to buy SoFi over 3 years. You can buy SoFi common stock. And it's tied to a school, so you can have a Stanford perpetual preferred or a Michigan perpetual preferred, and that 6.5 coupon, if the default rate in the school goes above 1% in the SoFi book, it drops to 3.25%, and if it goes above 3%, it drops to 0. Of course, all the numbers are 0% right now. People like that structure because it's tax advantage to them from a distribution standpoint. It's a reasonable yield, 6.5, and it's giving them upside in SoFi with the convert option into the common. And we're getting a lot of traction around that structure, and effectively, you're still, that capital ends up going into the equity position within the securitization transactions and other transactions that we do, but it's just a cleaner vehicle for the investor to take.
Right. Well, obviously, some investors aren't going to want to participate, are they? They're just going to want to, some people hear the word securitization and run for the hills.
Right.
So you're just saying, so you're giving obviously them the option to participate in the equity piece or not. Is that correct? Or is that?
Well, no. So the option is actually to buy SoFi stock.
Okay.
So it's a preferred stock with a convertible option into SoFi common.
Right.
And the point of that is what our investors, when people get engaged, they tend to really like the model. And the next question inevitably becomes, can I invest in the company? And what we've done with the perpetual preferred is given them a vehicle. It gives them a good coupon, gives them school affiliation, measurable social impact. They can see how much they're saving alumni from their school. But it gives them a 3-year window that if SoFi is successful, they're going to be able to convert that into a common stock position and participate in the upside.
I see. So your next securitization, it's going to be outside of that 6.5%.
That's right.
Okay.
That's right.
Gotcha. Okay, I want to switch gears and talk a little bit about some of the moves that you have made lately. You talking about home mortgages. I mean, I saw your slide at Lendit that had, it was like 70% of outstanding debt is home mortgages, and you're running a pilot right now, I believe. Can you give us the details? What are you actually doing here in the mortgage business?
Sure. So we tried to attack the mortgage space on 2 different fronts. One was around product availability. And in particular, if you think about our customer demographic, having a lot of free cash flow, but not a lot of assets, they want to buy a house in San Francisco, say it's $1.5 million. They go to a bank and the bank wants 30% down, and they don't have the $450,000 to put down. Mm-hmm. And so they're effectively locked out of the market. And what we've done is we've gone into the market on a product availability standpoint, we've gone to our capital market resources, and we said, look, if we do a high loan to value number, say it's 10% down, 90% loan to value, is that a loan that we can offset in the market as we're financing for it? And for our borrower, there's absolutely financing for that product. And so the second challenge around availability is debt to income threshold. So generally banks require you to be under 43% debt to income to finance a mortgage. Again, it's very hard to do that in the context of buying non-conforming mortgages. And we said, look, we'll go above that 43% debt to income threshold, which is effectively what's called a non-qualified mortgage. And non-qualified mortgages are interesting because banks are very hesitant about financing and buying them. But we were able to line up relatively large warehouse financing for non-qualified mortgages, the first in the market that anyone's done. And we started doing a pilot for our borrower base where they were able to do as little as 10% down for non-conforming loan amounts up to $3 million without a DTI restriction. And once we started educating people about this, the response has been overwhelming. We've just been doing this in California to date, and we've got about 125 mortgages in the pipe right now. We funded already over a very small number of that, but we're starting to fund a lot of that relatively quickly. And people really appreciate that the product's there, and they didn't know that the product was there before. They thought they were out of the housing market. And so as we've gone and we've educated people, they said, wow, I want to come in, I want to buy a house. I didn't think I could get this kind of a loan. But the other piece that we've attacked is the experience. So if you think about a mortgage experience, for example, I refied my loan. I won't say with who, but it was with someone I used to be employed with, and I tried to refinance my loan, and it was a 40% loan to value, and I had more on deposit at the institution than the loan amount. And I was rejected to refinance the loan that they already had. And I called up the CFO who I used to work for, and I said, you realize you rejected me for a loan? And he said, this is ridiculous. It's everything that's wrong with mortgage. Give me a couple hours, I'll fix it. And he called up a couple hours later. He said, there's nothing I can do.
Wow.
And what had happened was I went from a hedge fund salary to a startup salary, which is a pretty significant drop. Mm-hmm. And while I still had enough income in the startup to support the loan, they extrapolated what my income would be the following year, which was something like negative $500,000. And they said, you're not going to get the loan. So they ultimately did give me the loan, but it was a very egregious process. And then, to add insult to injury, I had to sit at my house on a Saturday and have someone come over and have me sign 300 pages.
Right.
And so we said, there's got to be a better way to do this. And so we were hearing a lot of concern about folks, competing with cash offers in markets like New York and San Francisco and Los Angeles, how difficult it was. And we looked at it and said, you know what, we've already underwritten these borrowers. And so we know what their free cash flow is. We know how much of a loan we can give them. All we really need to do is know what the property is. And so we set up a structure where if you're an existing customer, it's as easy as if you're walking down the street, you see an open house, you can walk in, you like it, and send us the address of that house. We'll do an electronic appraisal and commit a unconditioned loan to you at that point in time, which is as good as cash. Now, we'll still end up doing a physical appraisal in the back end of the process, but it won't affect the loan or the pricing. It's just something we need because otherwise we don't have access to the bank market. But effectively, we can get you a commitment to fund in less than a minute, and then we can actually fund within 10 days. And that's the process that we're trying to put in place, and just take a lot of the nuisance and the hassle and the fact that you need to answer tons of questions that aren't relevant or that your lenders already know out of the equation, and just make it a better experience.
Wow.
And people have really, really started to resonate with that as well. And so we're in the process of gearing this up for other states. So we're still doing California, but we're going to go to Pennsylvania, DC, New Jersey. The challenge is we'd really like to get to New York and Massachusetts, but those states are slightly harder from a licensing standpoint than the others that we're in. And remember, with SoFi, we do everything through our own licenses, so we don't have bank partnerships, and so consequently we. In some circumstances, it can take us a little longer to get into markets, but we think the cost benefit is in our favor there.
So how are these mortgages structured? Are these like 5-year ARMs, 7-year ARMs? What are you?
So we're doing a combination. So we're doing a 7/1 ARM. We're doing a 30-year fixed. We have an IO product as well, and we're going to do a pure floating rate mortgage in the next month. The floating rate mortgage, if we can do this, and I'll give you a scoop on what we're thinking about, because I don't know if we're going to be able to pull this off or not. But as we started thinking about higher LTV loans, and we started thinking, can we do a 90% LTV loan? What's the walkaway risk to the borrower? Obviously, we feel that we have alumni capital involved. There's some moral suasion. The guy doesn't walk away, or the person doesn't walk away as easily. But we started thinking about, do we really want the loan to be recourse to the property or to the individual? And in a state like California, which is a single action state with no deficiency judgments, generally lenders say that, in fact, almost exclusively lenders say we want recourse to the property. We actually think you probably, in the circumstance of high LTV loans, want it recourse to the individual. And so what we're thinking about doing, and this is still on the blackboard, but I think it's going to come to market relatively quickly if we can pull it off, is if you come to us and you want a mortgage, so say, Peter Renton comes and he wants a $1.5 million mortgage, we might say, well, look, Peter, we'll lend you $1.5 million, but it's to you. We're going to ensure you actually put the money into the property, but at that point, the loan is to you. So what that means is I don't care about the appraisal. There is no mortgage title. There is no escrow process. All these things disappear. I don't need your 1040s. I don't need your tax returns. I don't take any of those things now, but I certainly wouldn't need them in this circumstance. I'll just lend you the money, and I'm going to ensure that you, in fact, are going to buy a house with it. And then I'm looking at your balance sheet and your cash flow sufficient to support the loan. And if we can do this, this will be a game changer because it would dramatically reduce the hassle of a mortgage. It has the unique characteristic that if you decide to move, you could actually take the mortgage with you into a new house.
Right.
There's some pretty interesting dynamics on this, and this is where we'd like to go with the product. And we're working with some of our bank partners and capital market partners to finance this. And we think there's appetite for it. So we think, maybe by the fall, we'll have this product out there.
Well, that would be amazing. I mean, you've really got to have a lot of confidence in your borrower to do that kind of product, which obviously you clearly do, right?
Yeah, and we're certainly not, we're going into this eyes wide open, and so we certainly understand some of the ramifications. But, take, for example, I lend you $1.5 million, and the next day you file Chapter 7 bankruptcy, and California homesteading lets you take $100,000 of equity out of your home. So I'm out $100,000, but the reality is if you went into a foreclosure process, it would cost me at least that much to foreclose on the property. Plus, it would take me a lot longer to do it. And so if you actually look at all the different scenarios where you have bad actors on the borrower side, you generally don't end up in a worse position lending to the individual on recourse versus to the property.
Interesting. Well, I could talk for a long time about that, but I want to move on before I let you go. I want to talk about something new that I just saw on your blog. I think it was just earlier this month or late last month, and you were talking about going into unsecured consumer loans. I mean, are you going head to head with Lending Club and Prosper there? I mean, what's the deal with? Can you tell us about that new product you're offering?
Yeah, we're definitely not competing with Lending Club and Prosper in this, in the sense that while the product function is similar, the borrower is very, very different. Mm-hmm. And so we're effectively offering unsecured consumer lines to our borrowers. Again, this is opened up by the S&P rating. So if S&P gives me a particular rating for the way that I underwrite and price student loans, then if I'm doing the same thing for consumer loans, I'm going to get a similar rating and similar structure. And so what this has allowed us to do is for super prime borrowers offering very competitive rates. So you're talking about APRs in the 6% handle, mm-hmm. with initial 1-year rates in the 1 to 3% range for borrowers where they have. A lot of our borrowers have short-term cash needs. If they're coming out of a professional program, they're getting a life started, if they're buying a car. It's not so much card consolidation, which is the bread and butter for the Prosper Lending Club folks, and it's certainly not the 700 FICO borrower, which is a great borrower, but it's not going to fit in the structure that we're doing. So, well, that being said, we very quietly launched it. We didn't advertise it. There's no communication outside, but we're actually doing a decent amount of volume on that on a week-over-week basis.
Interesting. So what you're doing there, I mean, is this obviously preparing for another securitization down the road? I mean, are you going with the S&P rating? You said you're going to be able to package other loans together, right?
Yeah, but what the S&P rating also did is it just further validated the credit, and it opened up the bank market further for us. So we've got about $500 million of bank participation commitments to fund into unfunded at this point. And we know we can take larger transactions. The last securitization we did was $250 million of senior. We can take larger transactions into the market supported by a higher loan volume that we've experienced this year. So it's really there's a virtuous cycle. It's very synergistic that it just opens up the general capital markets for us.
Sure. So can individual accredited investors participate in the mortgages and the unsecured consumer loans? Is that a possibility today or going forward?
Yeah. So what we're doing right now is the only thing we're offering out there is the perpetual preferred. which will invest across all of that stuff, but there's not a direct correlation to the underlying loan. It's really tied to the cohort default rate.
Okay.
And we're trying to keep it relatively simple right now. What we're working on the tech side behind the scenes is we're working on a more transparent marketplace. So where we like to see things in 12 months is we'd like to give total visibility into everything coming through the SoFi pipe and allow retail and institutional investors, pari passu, to bid into everything that comes through the pipe in discrete sized chunks, to get capital providers like Cap One, for example, to provide leverage on this marketplace to the extent that you want to lever your investment. There's leverage structures there. But the most important thing is to actually let the market set the price. Mm-hmm. And what we do today is we're trying to create a marketplace, but we're not all the way there because, if you think about a marketplace, think about the New York Stock Exchange, the fundamental premise of that marketplace is supply and demand sets the price. And at SoFi, we don't do that today. We say what the loan rate is and we take it to the market. And, obviously there's a little bit of back and forth to make sure that it's a clearing price, but we would like to be in a situation in 12 months where if someone wanted to bid higher on a University of Michigan loan versus a Stanford loan and reduce the rate, that they'd be able to do that, and that we'd let the market clear price across every product.
Interesting. So that's in your vision to really be a true marketplace for your investors. Okay.
Yeah, that's right. And obviously, you can have grand ambitions to do that, but if you can't bring product to market, there's no point in even broaching the conversation. I think we're getting to a point where we've got sufficient volume across the core product, but we're also getting good volume pickup on the newer products. And so we can bring a diverse set of credit to market across an interesting customer demographic that would attract interest for both retail and institutional.
Okay, so it sounds like you're still using the student loan as a vehicle to kind of enter for your customers to really enter into a relationship with SoFi. That's still going to be the vehicle that you're going to use.
That's right. And to put it in context, this year we'll fund into about $1.5 billion of student loans, and we'll do about $300 million in mortgages. Next year, I'd like to do $2 billion of student loans, but I'd like to do $2.5 billion in mortgages.
Wow!
So we're kind of at that inflection point where we're starting to get acceleration on non-student loan core product that will become the new core product. Interesting.
So yeah, you've got a lot of runway. Obviously, if you're in both student loans, home mortgages. I mean, is this you mentioned auto loans as something that's in your product roadmap? I mean, what's your vision for SoFi? I mean, where are you taking this?
Sure. So I think it's underpinned by the concept of a marketplace, but all we've talked about so far is, actually not all. We touched a little bit on the asset side of the equation, but we talked about the liability side of the equation. We would like SoFi to be a comprehensive financial solution where it's sort of we're invoking the old Bedford Falls Savings and Loan from It's a Wonderful Life, where you keep your capital local. It's within and affects a community that you care about. There's always a measurable social impact of everything that you do, whether it's the amount you save someone by refinancing or it's by helping someone get a job. But the premise is it's a local community, but it's built around a larger infrastructure that brings economies of scale to financial services so that you're not disadvantaged relative to banking at Wells Fargo or Bank of America or any of the other mega banks. And to do that, we need to attack both sides of the equation. So I think it's pretty clear how we're attacking the lending side of the equation. What's in Skunkworks right now, but what's very important to us is how we attack the deposit side of the equation. And we're not a bank. We don't have FDIC insurance. So the way for us to build a structured deposit that is yielding, liquid, checkable, cardable, that's an important step for us in the process of delivering a comprehensive solution. And that's a step that'll happen next year.
But you're not going to become a bank.
We're not going to become a bank, but we would provide effectively bank equivalent services.
Right. Fascinating. Okay. Well, this has been a really fascinating talk from my perspective. I really appreciate your time, Mike. Thank you very much and best of luck.
Thanks, Peter. It's always great to talk to you.
Okay. See ya. Wow. Well, I hope you found that as interesting as I did. One of the things that I really appreciate about SoFi is that they are out there breaking new ground in this industry. They're doing things that have never been done before, whether it's an S&P rated securitization of consumer loans, whether it's this new mortgage product that they have. They're doing things that are really innovative, and with their strong management team, I think they're going to be a force to be reckoned with in coming years. So on that note, I will sign off. Thank you very much for listening, and I'll catch you next time. Bye.